Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30, 40 minutes or so. Action-packed webinar, actually, action-packed week full of top-tier events, big risk events, and obviously the geopolitical tensions in the Middle East overshadowing everything really. So we'll look, go through stocks really, essentially, look at some of the earnings that we've seen from the Magnificent Seven. We'll focus on those, their outperformance driving the indices, and then obviously these then rolling over since we've seen some of their results. And we'll just check out the S&P 500, of course, and the NASDAQ, and what's happening with their correction now from their highs in July. Moving on from stocks, then we'll look at last week's main events, which will be some of the data out of the Eurozone and the US, the PMI data that was. We'll focus on some of the other US data as well before then recapping the ECB meeting and looking at the Bank of Canada meeting as well and those associated currencies, so Euro dollar and dollar CAD. Before then wrapping up, or not wrapping up, getting to the main sections really of this, the main risk events of this week being the Fed meeting, of course. We'll also look at the non-farm payroll report on Friday, before then checking out the Bank of England meeting, the Bank of Japan meeting, and hopefully, if we have time, some Eurozone really important data, CPI and GDP data as well out this week. So really packed schedule of events. As I mentioned, firstly, well, just looking at risk generally and markets generally, European bourses, actually US futures in the green currently. Interesting really, just as geopolitical risk sort of premium that unwinds slightly from Friday. We have seen this over the last few weeks now that Friday is really a big risk off event. Investors really not wanting to carry over risk over the weekend, of course. So you get a bidding up in safe haven assets, in gold, in the dollar, in the yen and the Swiss franc especially. That has sort of happened over the last couple of Fridays, and then those risk off assets get sold into before then a mild bounce or depending on obviously what happens over the weekend. But in our case today, you've had crude and gold coming in softer this morning on that, as I say, geopolitical risk premium unwinding from Friday. European bourses, US futures in the green, as I've said, dollar slightly slipping now, with the Aussie outperforming really after stronger than expected retail sales overnight. Okay, let's move on to stocks now quickly. Corporate earnings really in vogue for sure. I think 24% of the S&P 500 market cap is now reporting. You can see last week we had this chart actually with the biggest week last week, but then this week, 30th of October onwards, it's the second biggest week. As I say, around 24% of the S&P reporting. Apple certainly the biggest name this week, out on the 2nd of November after the US close. Options pricing in a move around just under 4% possibility there. And the market will be focused on iPhone demand and consumer trends in China. That is Apple. I just want to probably just check out the chart actually, which we don't look at stock specific charts that much, but just bear with me 1 second. I'll just pull up Apple's chart, which is interesting because essentially rallies have been sold into of late. That sort of goes for most of these mega cap tech stocks, but you can see this chart here of Apple on the daily. So yeah, we've just had sort of this bearish channel, if you like, quite a wide channel, but yeah, as I say, rallies being sold into. We dipped down below this previous mid-August high, low at 170.53, and then you've got the 200-day moving average now, and we're below that. That's the first time since March last year that we've been below the March this year, first time that we've been below that. So interesting. It was only a short period last time, but of course you can see what happened previously. So yeah, it's just something to watch out for. So that 200-day moving average at 170.53. Otherwise, that break of support is around 171.96. A really interesting price action here ahead of its results on the 2nd of November, Thursday, that is. Generally, then, Q3 earnings really been really interesting over the last few weeks, sort of this relentless optimism that we've seen powering the Magnificent Seven. So that's those mega cap tech stocks. Those are, of course, the biggest stocks in the S&P by market cap. And ultimately, they've been pushing the broader indices higher, of course, this year. If you just step back, then certainly tech stocks entered the year with the odds sort of stacked against them, really, due to the Fed's aggressive policy tightening, rising of interest rates. Long-term treasury yields, of course, they provide the rate for discounting companies' future cash flow. So a higher discount rate will lead to lower valuations. This should be particularly true, of course, for stocks expected to deliver a lot of growth into the future. And kind of, therefore, it's slightly interesting, remarkable even, some are saying that obviously the Magnificent Seven have progressed so far with such headwinds. Of course, we haven't mentioned the AI sort of mania, which has been a strong driver. But of course, you can't forget these higher treasury yields. If we just check out then just what I'm talking about, which is just then what is happening now, essentially. And we can see this from the chart, really, is that, yes, well, the Magnificent Seven have been sort of responsible, as I said, for this year's S&P 500 performance. But then given the poor breadth, these stocks rolling over now, and there's a real risk potentially of a deeper recession. And you can see this chart, really interesting. The blue line is the black line really is actually slightly wrong, this, I guess. The black line is the Magnificent Seven, and then you've got the blue line, which is an equal weighted index. If the S&P at 500 was equally weighted, then we would actually be slightly negative. And that's giving, I think, each company, an equal weighting, whereas of course that isn't the case, and the Magnificent Seven have been driving the S&P 500. Their performance now looking as though it is now rolling over, so potentially we get a deeper correction. A lot of focus on this, of course. As I said, the idea of AI has been the genuine, has been the game changer so far. And then there is an argument around those Magnificent Seven companies retaining a bid as their role as a sort of comparative safe haven. Typically, they have strong balance sheets, and as Warren Buffett said, wide moats, but potentially that is quite not wide enough at the moment. Regarding results, the Magnificent Seven earnings really not too disappointing. The hopes really hinging on the prospective growth of the big internet platform companies look to have left these firms vulnerable to the slightest disappointment, and that's really what we've seen over the last couple of weeks. If you think of Alphabet, that saw its shares plummet 10%, nearly 10%, the most since March 2020 during the pandemic. The day after the Google reported a smaller than expected profit in cloud computing. The report otherwise was sort of, broadly speaking, not too bad, pretty healthy. But then Amazon, if you look at that tumbled for 2 days after those earnings, as traders kind of speculated it would have a similar problems in its the web services. area. Then the company results came out after the close last Thursday, looked to be ahead of expectations of both revenue and profits, but then after hours trading showed that investors still weren't sure. And even after its conference call, the company still had not made up all that ground lost after the first tech results 2 days earlier. And then on Friday, eventually closed up sort of nearly 7% or so. So retrace those 2 days of losses. So really what I'm saying here is that volatility is specific and among specific names. We've certainly seen some strong sell-offs with marginal misses really, and that is probably down to certainly this stretch positioning that we're seeing from a lot of investors who are long, and especially after the sort of long rallies that we've seen this year, and then it's just been major profit taking, and some of these big companies, Alphabet, as I said, plummeting almost 10% on the day after its results. Okay, just let's look now at the wider indices on a technical basis. And if I just pull up first of all, the S&P 500 chart. If we firstly look at the weekly, we can see we're just now on, really interesting, well, we've got this fib level from the sort of March lows up to the summer highs. And we're just on this 61.8 now, 4118 that is. So really interesting level of support potentially. That's on the weekly chart. And then you can see we've broken below that 4200 level, which we talked about a lot. Big zone of support. Includes the halfway point of that, the March to summer rally. That's at 42.11. You've also got that 200-day moving average, the thick black line there at 42.40 now. And we obviously moved them below that trend line support earlier on a couple of weeks ago. So yes, we're now 10%. Greater than 10% now from that July high. So that sort of denotes us being in correction mode. And we're actually on track for the third straight month of declines. If I just go to the monthly, you can see there, yeah, third straight month of declines. That's the longest streak since actually you can see the pandemic in 2020. So yeah, interesting sell-off. And also interesting because volatility measures. So we're looking at the VIX here, for example. That is only just above its long-term sort of average. It's at 20 now. Long-term average is around 17 or so. So it's kind of been an orderly sell-off, but one which has sort of got worse in the last couple of weeks or so that you can see there. Yeah, so 4240, 4200 key zone of resistance now, was support, now resistance, of course. And next levels, well, we got the 4118 that we said. Otherwise, really, we're going probably to these lows from May and April around just above 4,000 then. So big round number will get a lot of attention, and potentially there will be some support there, if not at the 4118 level. As for the NASDAQ, that's down now around, yeah, you can see 11% or so. From its July high. That means it's erased about a third of its gains for the year, really capped by the last two bruising days that wiped out. These 2 days, Thursday, Friday, wiped out around $800 billion off share values. And yes, we lost 2% Thursday, 2.5% Wednesday. Actually, Wednesday was its worst day this year. So yes, interesting now that we're getting a bounce. We're just above that 200-day moving average at 13,926, so just below 14,000. We've got a fib level in there as well at 13,932. So that's an interesting level of support there. That's of the this year's rally, actually, the 38.2 there at fib level at 13,932, as I say. Just getting a little bounce. We can see in futures. So sort of resistance levels will be, we would say, the September lows 14,432, and then potentially the next fib level, minor fib level 16. 14,696. That's the Nasdaq. Okay, let's just check out the Dow as well. You can see the big sell-off here. We lost that 200-day moving average. We lost the 34,281 as well. So now we're just going to the weekly chart there. You can see the 200-week moving average at 31,816 potentially, and ahead of that is 31,429, which is the mid-March low. So that should offer some support. Doesn't look great, does it, technically? And you can see that mid-March low at, as I say, 31,429 if we do move lower. We're getting into sort of oversold territory slightly, so we could see some retracement as well. But doesn't mean we can't go lower, of course. Okay, let's move now to last week's. Let's move now to last week's main data points. Firstly, we had PMI data actually out of the Eurozone, and the US as well. Really interesting contrast between I'll just pull up the dollar chart here actually, so you can check that first of all. But really interesting contrast between these key leading indicators. Eurozone, certainly Euro economic deterioration seems to be broad-based, both manufacturing and services sectors declining. I'm just checking what was of note there really for us. Don't want to go too much into the figures as we've got so much to cover, but overall, the PMIs in the Eurozone really signaling that the economy continues to cool in the fourth quarter, kind of what the ECB wants as both activity and prices fell. The labour market also cooled, with the manufacturing sector recording the largest employment declines in 3 years, while the service sector employment almost stagnated. So the risk really for the soft landing narrative, if you like, in the Eurozone, or hope for soft landing narrative by the ECB, is still that activity suddenly declines too fast. And currently this risk is mainly present in the manufacturing sector. We've seen that over the last few months, of course, and that continues to be certainly weaker than expected. All in contrast to the US PMI data, which was relatively healthy. The composite above 50 at 51, both manufacturing and services, they exceeded expectations. Manufacturing actually its highest level since April. Services, an improvement as well. And overall, really, just another upside surprise in US macro data, adding sort of broad support to the dollar. Details really showed easing service sector price pressures as well. That kind of points to less need for Fed tightening. Just good point to note there. We did have lots of other data out of the US last week. Pretty impressive. The US third quarter GDP, that came at 4.9% quarter on quarter, so that beat expectations. Strong private consumption, government consumption, private investments, even inventory building, all supporting the sort of strong growth performance. We also had durable goods data that was strong, and even the jobless claims, the weekly data, slightly more than expected, but still suggest a solid labour market. It was interesting, the actual reaction. I'm just going to get the 10-year yield actually, because after all that data, you would think we would yields would get stronger, but really it was kind of a buy the rumor, sell the fact kind of dynamic after that. And we did sell off after a lot of this data, so we didn't push above that 5% mark, which is key. We've highlighted that before on the 10-year Treasury, and you can see it has offered some resistance already to yields going any higher. Okay, let's now move to the ECB meeting. That was obviously last week. And I'll just pull up a graphic first of all that you can see from here. ECB obviously kept rates unchanged at their meeting. They guided that they are probably done with additional rate hikes. So look, President Lagarde seemed to be kind of on a mission not to rock the boat in terms of market pricing, and she did that pretty well, actually. If you tracked Eurodollar for sure and some of the bond markets, then they didn't move a massive amount, and really Lagarde highlighting uncertainty about the economic outlook, remained confident, though, that inflation would return to target if rates were maintained for a sufficiently long duration at the current level. That's a sort of current mantra, if you like, based on today's inflation. So that's the hope that the ECB is, well, the mantra that they're using, as I say, currently. Of course, given recent poor data, the bar for additional rate hikes does seem quite high. And you can see on here, obviously, this falling PMI data, and then that weaker GDP data as well. Interesting, Lagarde and the bank, they didn't change any guidance to continue reinvesting the proceeds from maturing pandemic emergency buying of bonds, at least until the end of 2024. Kind of can be considered as a sort of soft touch. The outcome overall then of the meeting was marginally on the dovish side of expectations, led to a minor dovish market reaction, although nothing major. As I've said, and also we had a decent US data about the same time as well. So it was difficult, slightly difficult to gauge the market reaction, but generally Lagarde did a pretty good job not rocking the boat too much. And now markets really pricing in the first full rate cut in June of next year. If we just pull up now the euro dollar chart. Which is here, still in a long-term downtrend. You can see we're just out of this bear channel now. I've kept that in there because it's just a great example of those lower lows, lower highs, and just a descending channel. We did pop out of there, but you can see sort of met resistance of the 50-day moving average. That's now a 106.53, but we're just sort of stabilizing. Kind of in no man's land, really, below 106, trying to get above 106 essentially. But again, we might get resistance then above that at 106.53 initially, and then sort of 107 area as well. Otherwise, if we roll over, we lose last Thursday's low at 105.21. That was just before the ECB meeting, I think. So 105.21 initial support. Before then, we get into sort of 105 area or so on euro dollar. Okay, let's move on to, well, we'll quickly move on to the Bank of Canada, actually look at dollar CAD. They, again, more or less delivered on expectations around the acknowledgement that tighter policy was acting to slow prices, and that the narrow kind of runway to a soft landing was getting narrower in a lot of ways. The bank's policy statement kind of had a slightly more hawkish edge to it. They altered the language in the policy statement itself, noted that progress towards price stability is slow and inflation risks have increased. The forecast, well, inflation forecast projections were lifted, and actually there was a delay of the return to target until 2025 from 2024. The bar to a rate hike is still high, but the risk certainly of higher rates will persist until there is clearer progress on core inflation. That's probably the key takeaway. If we just look at the monthly chart, interesting that this is dollar CAD now. Now we've had sort of persistent gains, dollar gains, that is, through 137 plus, and they're starting to make a little mark on these charts now, where 137 has been firm resistance on a monthly close basis. And if I just put up a sort of horizontal line around 137, I'll just see the point that I'm making here. That's around 137. Let me just make it slightly more accurate. So yeah, 137 is there. You can see that has been a level of resistance previously, and we're just now pushed up above that. So really interesting sort of price action, whether we can sustain these this move higher. And certainly if we get a monthly close, as you can see, that will be important if we stay above 137. I'll just leave that on there now. You can see the weekly chart there, and we're just bumping up now into this sort of March high at 138.62. You can see that on the daily, which we've got here. So really interesting sort of push higher, and whether then we get this stronger monthly close well above 137, 138.62 potentially, and then we go up to sort of 139.77, which is the last October's high. That's dollar CAD. If we do roll over, then probably 138 is initial support, and then these highs here around 137 actually. So it's a couple of round numbers to note in dollar CAD. Okay, let's move now to the Fed. I've just got some graphics here with all the sort of big numbers on for you to look at. All but certain really that the FOMC leave rates unchanged at 5.25% to 5.5%. On Wednesday, this is focus instead will fall on guidance for the December meeting. There aren't any new dot plots or new economic projections until December, that meeting. Money markets, many Fed officials really of the opinion that the Fed is done potentially with rate hikes. The central bank certainly proceeding carefully is what their terminology they're using to let cumulative tightening continue to work through as inflation trends lower and the labor market rebalances. However, certainly the latest economic growth resurgence in Q3 is what is keeping risk skewed slightly to further hikes in the near term. There's around a 20% hike probability priced in for the December meeting, currently around 30% priced in for January. I thought I did put that on here, but I haven't. So there, yeah, those are the odds at the moment. Concerns linger of a possible episode of kind of demand-led reflation from the US consumer, certainly, and just generally this overall resilience in the economy, in consumer data. And that has pushed out then the pricing of the first full 25 basis point rate cut back to sort of around July, August time next year. Noting, of course, that any rate cuts wouldn't be until late next year. That follows the September summary of economic projections showing that sort of 2024 end median rate dot hiked by 50 basis points to 5.25%. Just regarding data you've got in here, obviously the CPI data rose a tenth or so, but the core hit 4.1%, and then you had this blockbuster NFP, which we'll get into shortly. So resilient data for sure. And just on sort of recent Fed speak, then Chair Powell, he obviously spoke a couple of weeks ago in New York, kind of saying incoming data had shown ongoing progress towards sort of both the Fed's dual mandate goals, noting the unwinding of some of the pandemic related distortions and restrictive policy now was working to bring inflation down. Kind of pretty satisfied with current policy settings, Powell, and he didn't take alarm to the sort of this September pickup in CPI, really saying the path is likely to be bumpy and take some time, of course. He's also noted the lagged effects of the policy tightening, and certainly a big takeaway, and also from other Fed speakers, is certainly the acknowledgement that tighter financial conditions that we're now seeing from this big surge in Treasury yields could in fact lessen the need for further rate increases. So that'll be key whether he repeats that. I think some are relating that to around the equivalent of 75 basis points of rate hikes, this tightening of financial conditions. So the speech overall then, just going back to that, was gauged as confirmation no hike this meeting, of course, whilst also seeing raising the bar for a hike in December. And that's deviating from the September dot plot, which had penciled in one more rate hike, which I've got in here. So this is a path of the Fed funds futures, and you can just see then these rate cuts priced in sort of middle of next year, and the small chance of one more 25 basis point hike. As I say, 20% chance, 24% chance, I think now, of a December hike. That goes up to around 30% by the January meeting, before then on hold until sort of middle of next year. That's potentially what we're seeing so far. Well, not potentially, that's what markets are pricing in currently. Also, just on this week then, there is some focus actually on the Wednesday release of the US Treasury's quarterly refunding announcement, where attention will be on the size and the mix of Treasury issuance, which, yes, many of you won't follow that. Many fixed income traders, many traders don't follow that, not too well known. But if we just remember the August announcement, the refunding announcement, that did cause quite a stir, especially with Fitch downgrading US sovereign debt the day before the refunding announcement, as essentially the US Treasury detailed increased auction size in its financing plans, which proved to be then the key driver behind US yields rising sharply from sort of 4% and then up to sort of close to 5% where we are now. So potentially it poses a sort of risk event for US bond markets that could tighten financial conditions further and then deliver sort of risk-off type conditions. So just bear that in mind, as some I know are citing that as being a bigger risk event actually than the Fed itself. So just watch out for market moves around that event. Otherwise, in the US, we do get a lot of labor market data. We get the ADP payrolls. We get the employment cost index. I think that's tomorrow. That could be interesting. Then we get the jobs, JOLTS, job openings, job vacancies, basically. Then obviously the weekly initial jobless claims, then all coming ahead of the NFP report. That's Friday, of course. The headline expected to rise by around 170K. That may change through the week, obviously, with all that employment data. And that is, of course, easing from that blockbuster 336 we had previously. And we also had, of course, those big revisions in July and August to note. Unemployment, that's set to remain unchanged at 3.8%. That tallies actually with the Fed seeing the jobless rate around that figure, 3.8% at the end of this year. Wages expected to rise by 0.3%. That's a pickup of 1/10 from the prior 0.2%. And then, yeah, you've got that chances of, I knew I'd put it somewhere, chances of a hike in December and then also January. Of course, a hot jobs report that will likely push out expectations of a rate cut and then potentially increase these percentages here. And obviously then a cool report would do the opposite and price out some of those, that chance of a rate hike in December or January. Just thinking back, the September release, as I said, that saw that blockbuster headline beat, huge beat, but it also saw unemployment rise and wages cool. So it'd be interesting to see whether that does follow through in this report and into the October data. As for the dollar, we didn't quite get on that, did we? So let's just pull up the DXY chart, which obviously is pretty much the inverse of the euro dollar chart. If you think the DXY has a weighting of around 56-57% of the euro, so along with then 5 other currencies. So the inverse, if you like, of the euro dollar chart. So bull channel, just come out of that now, but we've tapped sort of the 50-day moving average and also that fib level just above 105, 105.38, 105.46 now, the 50-day moving average, and we're just sort of oscillating around the midpoint of this range now. Yeah, highs at 107.34 and then that low around sort of 105.40 or so. So that's the sort of range. And interesting whether we do break out of that with all these risk events. We do as well get ISM data, which will be important, manufacturing and services. Manufacturing still in contractionary territory in the US, but well above levels typically seen during a recession. That's interesting to note. Focus will be on prices paid, new order components, just to see where we're going, where we're heading. And then for services as well, that's expected to tick modestly lower, but then still well above 50, that boom bust level. And it's really this resilient consumer picture, which is continuing to drive relatively healthy growth and underpinning support, of course, for the dollar. Okay, let's now we'll get to the Bank of England meeting first of all. If we just get a graphic which I've made similar to that Fed graphic. Yeah, Bank of England expectations actually might be quite a quiet meeting in some ways, or one of the most predictable, certainly, that we've had in quite a few months. Really expectations for the MPC to stand pat on rates, so keep rates at 5.25%. And a 90% chance of that happening, really, so 10% chance, minimal chance of a rate hike. Expectations really will follow suit from the decision in September, really. Pausing then its hiking campaign. That was a 5-4 vote. Excuse me. After the August CPI data came in cooler than expected, services inflation falling to 6.8% from 7.4%, sorry. And then since that meeting, September CPI has held steady at 6.7%. That's the headline, while services actually ticked a touch higher to 6.9% from 6.8%. Elsewhere, we've also had earnings growth, wage growth. That's slowed to 8.1% from 8.5%. Unemployment rate dipped actually to 4.2% in August versus the MPC forecast of 4.1%. That said, remember that the sort of data collection is slightly iffy, so taken as sort of cautious by the markets. In any event, the lack of any sort of notable hawkish developments since the prior meeting will mean they sit on their hands. The vote is kind of slightly a guessing game, simply because, we were 5-4 last time, very split. But then let's remember, one of the dissenters, Cunliffe, has been replaced by Sarah Breeden, and she will, in all likelihood, probably vote with the consensus. So that will tick up to 6 against 3, or maybe 7 against 2. The policy statement that will be interesting, whether will continue to reiterate this phrase of further tightening would be needed if evidence of more persistent inflation pressures is seen. It'd be interesting to see whether that's exactly the same. And then looking beyond the upcoming meeting, polling from Reuters suggests the economists expect the first rate cut from the MPC won't come until at least July next year. We do get the accompanying monetary policy report, the MPR. Those polled by Reuters again believe inflation will average 2% in 2025. In 2025, 2.2%, and then a return to target not coming until 2025, as we've said. On the growth front, polling suggests the UK will avoid a recession, but the outlook remains weak, with 2024 annual growth seen at just 0.4%. Okay, that is the Bank of England. And again, the chart, you can see small chance still priced in of a possible rate hike. Certainly with inflation still being elevated, but set to come down in the coming months, and then we get rate cuts, as I said, not priced in until sort of middle of next year, same as the Fed. If I just go into I'll find the cable chart, so that's sterling against the dollar. Again, nice bear channel, a series of lower lows, lower highs, as you can see. We're now sort of just midway between the recent high at 122.88 and the low at 120.37, just picking up unchanged really on today. And you can see sort of much narrower candles, smaller ranges, and that potentially means then we get range expansion as we're having sort of contraction here And generally, that means we get the breakout in line with the dominant trend. Doesn't always happen, but that's a general rule that we use. So interesting whether we lose then that last Thursday's low at 120.69, then we're likely, it would look like, heading towards the lows at 120.37. But we shall see, and a lot of risk events on the horizon. Bank of England obviously coming just hours after the Fed meeting, and just before then the NFP meeting. So a lot of volatility potentially expected if things don't go as consensus sees them. Let's now just get to the Bank of Japan meeting, the BOJ, that is overnight tonight. Expectations, really comes at a time of pressure of Japanese financial markets. Really, the 10-year JGB, so that's Japanese government bond yields, that touched 0.9% for the first time in over a decade this morning. Dollar yen, of course, has been above 150 last week, while the Bank of Japan resorted to unscheduled bond operations and suspected FX intervention, alongside Japanese officials providing quite a lot of jawboning. So yeah, a lot of pressures really in Japanese financial markets at the moment. BOJ, generally consensus is expected for them to maintain rates, policy measures and forward guidance as was, so no changes, but there is growing speculation, there always is now, around BOJ meetings and possible policy changes. Rumours in the run-up to the meeting were about upward revisions to the inflation forecasts, so greater than 2% for fiscal year this year and 2024 fiscal year, and then possible changes around the loosening in the yield curve control policy. And that sort of all further underlines expectations, as I've said, that a next step would be policy normalization. We haven't had it yet. We've had tweaks, but then those tweaks have been just to highlight the those tweaks have been due to what policymakers are saying, just providing a smoother functioning of markets rather than an actual policy change. So interesting whether we get anything like that. Again, markets jump to a quick conclusion that it's policy normalization, and then the BOJ pushes against that during the press conference with Governor Ueda speaking. Certainly, if we don't get policy normalization or anything like that, then the yen certainly risks sliding at a pace that potentially no FX intervention can call an immediate end to. We shall see. As I mentioned, we have had stories last week only, even suggesting the Bank of Japan is said to see little need to change forward guidance, but then is considering whether to tweak yield control policy given US yield concerns, while the discussion over YCC is reportedly not due to the growing risk of upward price fluctuations in Japan, which is seen as transitory really, but the impact on Japanese yields comes from the upside in US rates. So interesting whether we get any differences from those sources stories that we had last week. Dollar yen, pretty self-explanatory really, bumping up against 150. We moved above there to that higher 150.77, but then fell back down. The high from last October is in here, 151.94. You can see then, and obviously then rumours that, and then confirmation that it's Japanese authorities spent around $70 billion or so on intervention, first time in many years, and then we fell quite sharply. So yeah, interesting, really interesting time with the Bank of Japan possibly under pressure or not with the yen. Okay, finally, just very quickly, I'll just run through. We still have other data as well. Eurozone CPI and GDP. Just very quickly, CPI expected to cool to 3.4% from 4.3%, and the core as well falling to 4.2 from 4.5. That's here. A lot will be down to base effects from government support that last year ended as well. That brought down September figures. Stickier services inflation could possibly limit the scope for any downsides, core surprises, but we still will get decent numbers, well, falling numbers at least. And that may not, of course, support the euro. GDP, that's seen contracting. Negative 0.1 versus 0.1 expansion in Q2, while the year-on-year rate is forecast at 0.2 versus 0.5. So again, weak numbers, not really supporting euro unless we get some sort of upside surprise. Okay, I think we'll wrap it up there. We've spoken about a lot. There's a lot going on, so please do follow us on social media and also on our daily reports that we put on the website. A lot going on, as I say, so do take care out there and have a good week. We'll speak to you same time next week on Monday. Okay, all the best.